Welcome to the Life Success and Legacy Podcast. We're super excited. We are taking on a worthwhile endeavor at Life Success and Legacy. Our intention is to honor Nelson Nash, the man, as well as the infinite banking concept. We're going to create a series of resources, including podcasts and text, as a resource for others who want to truly understand with depth and clarity what Nelson shared in his book, Becoming Your Own Banker, as well as the many seminars and think tanks that we were fortunate to have attended during his life. So who is this intended audience? Well, we will use Nelson Nash's own words. It is written for the layman, not for financial advisors, but all life agents should be thoroughly knowledgeable of its content and practice. So whether you are an individual, part of a family, a business owner, or a life insurance agent, this is for you. So sit back, relax, and we will walk you through becoming your own banker step by step so you can reference the parts you want to revisit at your own pace. And we might have a little fun along the way. Hey, we want to welcome everybody back to our next edition of the Life Success and Legacy podcast. My name is Chris Bay, part of the team here at Life Success and Legacy, and joined by the founder, Michael K. Everett.
Good
Dr.
morning.
Everett, how are you this morning?
I am doing awesome.
What is your doctorate in, by the way?
A doctorate of everything. Oh my goodness.
That brings up some stories, doesn't it?
Way too many. I was just telling somebody, I said, my business partner, he always says, Mike, I've never seen anybody talk about more things that he doesn't know anything about with maximum amount of confidence.
That's right. It's all about the delivery, right?
I'm telling you, I get excited about a lot of stuff, but infinite banking might be real close to the top.
So we're going to test your knowledge on infinite banking today.
Come on, let's
dive
go
in a little bit deeper. So the last podcast we did, we are on page 51 of Nelson's book, Becoming Your Own Banker. We're in the 5th edition. And we are in section 4, equipment financing. And the last podcast, we just started to open the window here. What we're doing is we're transitioning from personal use of infinite banking into business use. And I always say the concept of banking is pretty simple, infinite banking. Where it starts to get a little more complicated seems to be the rules and some of the details related as the life insurance part. When you just look at banking and borrowing from yourself and paying yourself back and those kinds of things, it's pretty straightforward.
Pretty simple.
So that's where, a coach comes in handy, is to help you kind of navigate some of those additional things, because as Nelson discovered, whole life insurance is the best place to store your money as your pool to use for infinite banking. So we're picking up at the bottom of page 51, the second column, right at the very end of that page, where it says, no matter how you look at it, the above is a pretty good scenario. Before we jump in, one of my favorite quotes is in the section that we're going to talk about, and I want to open us up there. Nelson says at the bottom of 52, the first column, he says, everyone should be in 2 businesses, the one in which you make your living, and the other should be the banking business that finances whatever you do for a living. And of the 2 businesses, banking is the most important. I love that quote.
That is an awesome quote.
Yep. Okay, so let's get back to this. Set the stage for us. We've got a gentleman who is in the logging business, and he has somehow started this life insurance policy, but he really doesn't know what he's got or how to use it.
Well, if we go back to, and we're going to kind of set the stage just a little bit more. We were in the equipment financing illustration 1, where he decided to take $40,000 a year of his profits and create a whole life insurance policy designed for infinite banking. So he took the $40,000, he paid the premium for 4 years, $160,000. And you'll notice that he has 157,363. That's the third column from the right on page 54.
Okay, so on page 54, just so people, if they've got a book in front of them, page 54 is equipment financing illustration 1. And Mike, you're referencing how much he's put into it, the $40,000
the net
a
outlay
year.
in column 1, where it says $40,000 and it's got 4 years. So really what he's doing is he doesn't understand the banking portion yet. And what he's doing is taking his $40,000, he's putting it on deposit with the life insurance company. And he's saying, hey, life insurance company, I want you to take care of all of everything that's going on. So keep in mind, from then on out, and I'm just going to touch on this for a second, he builds cash value, he's got death benefit, and at age 65, he starts pulling out $92,000 a year. I mean, if you looked at that just in general, you would go, wow, let's do this. Mm-hmm. Now, I'm going to jump over to page 55. Figure 2 says the Great Wall of China. So if you look on the far right-hand side of this thing, this guy has 4 logging trucks. He has 2 tractors, and those tractors are basically the things that pick up the logs after they're cut and puts them on the logging trucks. But he has 1 tree shearer, and that's the one that just shaves off the big giant trees. Now, the tractors are twice as expensive as the trucks, and the tree shearer is twice as expensive as the tractors. And if you'll notice right under where it says 4 trucks, 2 tractors, and a tree shears, it says $16,000 a month. That's what he is financing with the air quote regular financing company. Now, just for fun, if you take $16,000 times 12, it's $192,000 a year. He is sending out the door to finance all of the junk that he's doing with his business. That's a potload of money.
Yeah.
So if you, now we're gonna sneak back just a little bit, because we started at the bottom of page 51 where it says, it dawns on him. It says it right there. I'm paying $16,000 a month to the pool for the equipment used in my logging business. And the finance company, the gatekeeper or toll taker, is borrowing money they lend me from life insurance companies and adding a surcharge to it and retailing it to me. So if you go, wait a second here, the place that I'm borrowing the money is doing the same exact thing that I could possibly do for myself. So why? This is just, that's the equivalent of my wife shopping for groceries at Winn-Dixie when we already own our own grocery store. So what we've got to do is we've got to have a shift in a brain. There has to be a major shift. And the question is right here, can I finance a logging truck utilizing the cash values against my life insurance policy? Can I do this?
Absolutely.
He absolutely can. So since he's the owner of the policy, he outranks all the borrowers in access to the pool that must be lent to make that life insurance plan work. So what does he decide to do? Okay, so remember, in illustration 1 on page 54, he decides not to do anything with it, but then all of a sudden it dawns on him, he's financing $192,000 a year, $16,000 a month. So we're gonna move kind of quickly here. Chris, do you think we ought to touch a little bit more on the Great Wall of China?
Well, I think when we look at that, I do. I think we ought to break that out for people, because it really, for a business owner, for them to be thinking about, okay, these premiums that I'm paying are really building that money pool.
They are.
And just kind of really break that down for people, if you would, that illustration on page 55.
Okay, so if most of the people who are listening today understand that there's only one pool of money in the world. It doesn't matter if it's life insurance companies, finance companies, banks, whoever. Everybody goes to the same pool. You and I, banks, everybody's going to the same pool. So the problem is most of us are not putting enough money into the pool in order to access the portion of the pool that we need in order to make infinite banking work. So,
or another way to look at it is also we're not putting enough in, but also in some cases, the rules of the pool or the access to the pool are not in favor of us.
Such as a 401k, mutual funds, IRAs, and the whole shoot match.
Yeah, or even we don't control the rules. So for example, credit cards, bank loans, things like that, they're all accessing the same pool, as you said, but either the rules don't benefit us or we don't control the rules.
We are beholden to whoever we've borrowed the money from.
Because we're outside of that Great Wall of China.
That's exactly right. And this is exactly what the problem is for this young gentleman who's got a logging business. So part of what we're getting people to understand is when you have your own pool through a dividend paying whole life insurance policy, the amount of premiums that you are putting into your pool makes all the difference in the world. Now, I'm going to kind of do a little sidebar right here. This is exactly why at Life Success and Legacy, we create a step-by-step strategy for every single one of our clients. We want people to know that if we can't put you in a better place tomorrow than you are today, then guess what? You probably shouldn't do IBC. At least you won't do IBC with us. But part of the education and part of the I guess, investment that everybody makes into their IBC journey is different for every coaching team. And we want to make sure that before you take a step off the high board, that you know what you're getting into. So we take the education piece of this very, very seriously. This is why we do these podcasts. We want people to understand life's hard enough and money's a big deal. And if we can get somehow to take the emotional stress of the money piece of this out and get you some freedom, some flexibility, then everything works differently. So keep in mind, in this particular example, you're looking at lots of different things that are going on because what you've got is this big money pool, and the money pool you're putting in is premiums. Well, not only do those premiums create dividends, but they also create a fairly sizable amount of cash value that you have access to against your policy. And if you take a policy loan against that policy, you'll notice right under Great Wall, there's loan repayments. So we're going to help you think about being responsible back to your own system exactly the way you would if you borrowed money from a conventional bank. If you borrow money, you got to pay it back. If you borrow money, you got to pay it back. So it's important to understand that. But in that whole money pool, you have expenses to operate. The life insurance has expenses to operate their life insurance company. So those are also coming out of the money pool. And also you got from time to time, but not very often, somebody gonna die. So there is a death claim that is all tied into that entire financing, everything that's going on inside that money pool. That makes sense?
It does. Just below that, if people are looking at their book, I think we touched on this, but I think it's really helpful to be reminded of it. Nelson says, whenever a large pool of cash is accumulated, there is always a barrier of some kind to keep most folks out.
Yeah.
What whole life insurance does is it allows us to step past that barrier, be inside the wall, and actually control our own financing situation. That is why Nelson says everyone should be in two businesses, and banking is one of them, and it's more important than whatever else you're doing.
Man,
that's good stuff.
there is so much going on this page. It is absolutely unbelievable.
Yeah.
So, when a life insurance company gets premiums in from the policyholders, they have to do something with that money.
Mhm.
So if we as policy owners don't access the availability of cash values that we have against that policy, then that life insurance company is going to take them out there. They're either going to invest them or they're going to loan them out to a finance company.
Why?
Because that money's got to move. It's got to flow. And so keep in mind, we keep things pretty basic here as our crew. So think of all the things that we got taught as consumers, as employees at our jobs. We got taught to put our money over here into a 401k, an IRA, a mutual fund, and let it sit. Is that correct?
Yes.
Well, and then, once again, I'm getting super basic again and going back to some of our very first podcasts. What are those people doing with that money? They're out investing it. They're out making it flow, but yet they're telling us to let it sit. So they are doing 100% opposite of what they're telling us to do. They're telling us to let it sit, but they're moving the money. They're getting the flow. So who gets the benefit from that? They do. So we want people to understand that what we've done is we're teaching you how to create a system where you personally, whether it be personally or through business, can create a automatic flow in your own cash flow. Man, that's good.
So Mike, let's dig into now that this logger is starting to get a little bit of an understanding and talk about the financing of that first truck, Exhibit 1.
Well, in Exhibit 1, you'll notice that
this is on page 56, by the way.
There we go. He's buying a 1984 Peterbilt. Obviously, this was something that Nelson did back in and this was early on. This was when he was really putting all of his thought processes together. But he bought it. This is a new loan, and the cost of this truck is $65,790. That's the total cash price. So if he came in, wanted to write a check, then that's exactly the way it happened. But you'll notice in number 2, the down payment that he puts down on this truck is $13,190. More than likely, it was a trade-in from an old beater that he had sitting on the lot, or it could be cash. It really makes no difference. It's got cash here, but it really makes absolutely no difference. So down at the bottom in unpaid cash price, you'll notice $52,600 is the cash price. If you subtract the $13,190 from the $65,790, there's the $52,600. So this is the financing that he is doing now that he's thought through the infinite banking concept process. So there are 2 places to get that money. You can either finance it at a local bank, the Great Wall of China, or because he has created, and I'm going to go back to illustration 1 for a second. In the fourth line, third column over from the right, he has $157,363,000 in cash value. Now, here's where some of the fun stuff starts. In number 4, insurance. You will notice that this is the largest section on this entire page. This is the required physical damage that you must carry on your car, truck, whatever. So when you go down and borrow money for a car and you go buy a Ford, what is one of the things that the dealership requires before you drive it off the lot?
Gotta have
insurance. You got to have comprehensive and collision, but you will notice in every single one of these things on collision, comprehensive, it says not applicable. I wonder why that is. And Nelson used to say this all the time. I mean, let's get real. Well, before I get there, I've got to actually touch on why the not applicable is there. Because he's borrowing the money from an entity that he owns and controls, comprehensive and collision are not essential to this business deal. But yet you must carry liability. That is just a must. But the reason why he doesn't is because he's borrowing. So he's really truly paying cash for this thing. So comp and collision are not required on this contract. Now, Nelson used to always say, he'd go, well, now let's get real. He goes, if you got a logging truck busting down the road and it just decides to go off the ledge and wreck, he goes, what are you really going to get for this truck? And chances are he's probably already made the profit on this thing, et cetera, et cetera. So it's going to probably more than likely be totaled. He's probably going to be carrying 100,000 pounds of logs, and probably everything in its way is going to get wrecked, but that's neither here nor there. So the official fees are not applicable. So if you go down to number 6, you got a principal balance of $52,600. And then we have the finance charge of $19,496. Now, this is a commercial loan document. In 99.9% of all commercial loan documents, you never see a percentage rate. You never see a percentage rate. I wonder why. Because they've got that all built in, and what they've done is they've convinced the business owner that, you know what, you're going to get a write-off anyway. So if you do a little calculations, you're going to find out that most of the time when you start to look at commercial loans, this is going to be somewhere between 15 and 19% as far as what they're charging. Now, who is that $19,496 finance charge coming from? That's coming from himself to himself. Let me say that again. He's borrowing the money from against the life insurance policy. He's paying cash for his truck, but yet as a business owner, you still want to take advantage of the deductions that you can get. And so if he's paying the $19,496 as a business expense, is that expense deductible? 100%. And we'll get into some of the other fine details. So you'll notice that the time balance, the contract balance is $72,096. We're going to use $72,000 just for fun. So if you took just a quick look at this and took the $72,000, and I'm doing this on my calculator, he's going to finance this for 48 months. And you will notice down in 10, the payment schedule, his payment is $1,502. We're going to use $1,500. Nelson liked rounding things off. We love rounding things off. So that means that if you looked at this over the 48 months, he's going to pay himself $1,500 a month. That's $18,000 a year now that he's going to be paying who? Himself. So out of this $192,000 that he's already financing with the gatekeepers, the toll takers, he's going to pull $18,000 a month out of this equation and pay himself. That is that's a shift in the right direction. So
Mike, go ahead.
No, you go ahead.
Well, I was just going to say, when you talk with business owners and they're starting to understand or begin to kind of wrap their brains around the benefits of this, where is it that you see most of them maybe struggling with the concept? Obviously, there's some that just jump on it right away and they're like, oh, why would I not do this? This is amazing. For those who struggle or just it doesn't click for them right away, where are the places that you see them struggle?
Well, remember, we talk about the ruts in our brains. We all have financial people that have told us certain things. We've all had CPAs tell us certain things. And part of what we've got to do is we've got to get past the barrier of the things that we have been taught. CPAs sometimes cloud a business owner's judgment because he's saying, well, you can lease the car, you can finance it, and you can do all of this through your business. Well, what we're trying to do is we're just trying to add another layer in there. Do you have something else in mind where you would
No. I was just curious from your experience with business owners where, if they get stuck or it doesn't click for them right away, where are those blind spots for them?
Well, the blind spots is because of all the things that we've already previously been taught. I personally don't like throwing CPAs under the bus.
Right.
But yet CPAs think in a 12-month window. They don't think long-term. Oh, principle number one, think long-term. So we've got to get people to think down the road 4, 6, 8, 10 years, because we haven't been taught to think like that, except for when you're thinking about your 401k and your IRAs and your mutual funds, which are truly, truly not created for you. They're created for the people that actually hold that money.
Right.
But yet we've been duped by the system to think that they're for us. I mean, and I always say this, and go talk to a bunch of 65 to 80-year-old guys and ask them what they think about their 401k plans right now. It'll be kind of a rough conversation, I guarantee you.
Okay. So this logging gentleman, he gets to the place where he's like, okay, I have access to this cash value and I could take that money as a loan and loan it to my company and then make the payments back to myself. Let's pick it up from there.
So he borrows $52,600. So we're on illustration 2 on page 59. You'll notice this is the same exact illustration. He's put the $40,000 in for 4 years. That's $160,000, and he's got $157,363. He borrows $52,600 out, and he goes and pays cash for the truck. But yet we've created the note, we've created the payment schedule. He's going to pay himself $15,000 or $1,500 a month, $18,000 a year. But how much did he borrow? $52,600. Okay, so I'm doing this on my calculators because I want the numbers to be lined up with what's going on in the book right now. How much did he pay himself? $1,500 a month or $18,000. So I'm going to subtract out the $18,000 that he paid himself. And you will notice in line number 5, it says negative $34,600. So this is the $52,600 minus what he paid himself over that first year. And he's still in a negative situation because he's borrowed that. So if you go to the cash value column, third column from the right, he had $157,363, and in line number 5, he has $129,387. We pulled out the entire $52,600. He's paid himself back $18,000. So you can see now, all of a sudden, this thing's going to start to grow. And you will notice in line 6, 7, and 8, it shows the $18,000 payment coming back to himself. Now, keep in mind, somehow, some way, what Nelson has done in the midst of all of this, he has run 6 or 7 calculations on every single line. Back then, when he wrote this book, there was no illustration software to show this stuff. he had to do this all by hand. So he does the very first truck from year 5 to year 8. And in line 9, he does one more truck. Now we're going to scoot through this pretty quick, but you will see in line 9, line 13, line 17. That's when he does one truck every 4 years. And the same calculations are all applying to this. Keep in mind, we all know that the cost of trucks is going to go up. We all know that financing is more than likely going to go up, but yet in order to keep things super simple and understand that we're keeping the banking part of this in the logging owner's control.
Mm-hmm.
We're just using the same exact numbers. So if you go back and you think about illustration 1, he put the money on deposit, and at the end of the rainbow, he had cash value, he had death benefit, but he pulled out $92,000 a year at retirement to live life.
Mm-hmm.
Well, in this particular example, we only financed one truck every 4 years. One. Let's go down to line 37 at age 65. The first year, he pulls out $100,000. Well, before we get too excited, I'm going to go back to illustration 1. In illustration 1 at age 65, he had 1.517 million. And in this particular example, when in illustration 2, he had 1.988 million. How many trucks did he finance? One. Okay, so did this have anything to do with the insurance company? It had zero to do with the insurance company. It had everything to do with how he functioned with his own cash value. That's what's so unbelievable about this. So over here in the far left column where it says total net outlay, you'll see the negative 100,000. And then in the second year or year 38, he starts pulling out $125,000 for the rest of his life. And
so that's the passive income that he's just gathering now from his policy.
He's just taking it out. So you'll notice in the second to right-hand column at the bottom, he took out $2,034,800 more than he put into this thing. And what did he put into this thing? 160 grand.
Mm-hmm.
All he did was he accessed the cash value available against the policy and financed one truck every 4 years. And in the first example, in illustration 1, when he died here, he passed on $2.4 million. In this particular example, and when he financed one truck, he passed on $3.1 million to the next generation. And oh, by the way, that death benefit goes income tax free to his beneficiaries.
So just to summarize this logger improved his situation by taking control of the banking function of financing one truck.
One truck every 4 years.
Yeah.
It's almost mind-boggling.
Mm-hmm. Now, sometimes people get confused because they think by financing, you're actually improving your policy or growing your policy bigger than what it originally would have been. So we've got a little bit of a comparison here between illustration 1 and illustration 2, and clearly illustration 2, the numbers are better. Can you talk a little bit about that confusion that people have?
Well, first of all, the policies only hold so many dollars. And we use the example, I don't even have a cup handy, but we use the example of a cup.
I got a cup.
When you fill that cup up with water, tea, or coffee, how much will it hold? Whatever it is up to the top. When the infinite banking policy is designed, it only is designed to hold so much money.
Mm-hmm.
And be it good or bad, when we design these policies, we only get them to hold so much money. So this really goes back to thinking long-term, not being afraid to capitalize, but not stealing from your system. So many of our clients access their policy very early on. Like we do this usually in the first 1 or 2 months. And so the availability of cash value is very low for some of our personal policies and even some of our business policies, because we've got to have a starting place. But you will notice in the book, when Nelson did the twins earlier in the book, they capitalized the twins policy for 7 years.
Yeah.
In the equipment financing, he capitalized the loggers policy for 4 years. Why? Because of Parkinson's law. Because if we get a hold of that money, what are we going to do with it? We're going to spend it and it'll be gone. By creating a larger pool of money, that means that all we're doing is we have access to more dollars on the front end to be able to do something like this logging truck. But then helping people, if we're doing our coaching right, we're helping people create a financing agreement between themselves and their business, so we can get that money to move back and forth between entities that they own. So they control 100% of the banking function.
One of the things that I'm recalling, Mike, and you can add to this and clarify it, but one of the things that I'm recalling is in the illustration 1, the logger obviously is not financing anything in illustration 1, and because he's still thinking of his premium as a bill,
Right.
he actually is using dividends and paid up insurance to cover premiums.
That's right.
And so he's actually not putting as much into that policy as he could. It could be even more.
It could be.
And then when he transitions to the second illustration where he starts financing his truck, now he's got these payments that are going in, and he's not needing to use dividends and paid up insurance to pay premiums because he's got this extra cash flow that's going in that's paying those premiums. Am I correct in that?
You're 100%. So if you go back to illustration 1, you'll notice it takes 17, 18 years before this thing starts churning again. If you go to illustration 2, we're talking 1, 2, year 8 is when this thing starts to grow, because what's happening is he's created a cash surge into the policy, and his payments are actually being utilized for premium dollars.
Yes.
So the misnomer is, yeah, we're making payments back towards the policy loan that we've taken against the cash values, but yet could those policy loan repayments be premium?
How often do we have clients who say, so now I'm doing all these policy loans and I have to pay the premium?
Oh my gosh.
Right?
See, there's a disconnect.
Yeah.
Because can you use your policy loan repayments as premium dollars?
Goes back to the cup example. If I've got, here's in this hand is a pitcher.
Yep.
And I'm going to take my pitcher and I'm going to pour my premium dollars and I'm going to fill up that cup.
Yep.
Okay. Now, the cash value that's available inside that, I can use for anything. If I take a pitcher and I pour more premium dollars into it, I'm going to increase the size of cash value available. But I can also do this. I can also suck out that cash value as a loan, turn around and use it to pay the premium as well.
That's right. So here's one of the cool things that I always think about, especially when I get to illustration 2. How much did he borrow for truck number 1? $52,600. How much did he pay back to finance that truck? $72,000.
Mhm.
Where did those extra dollars go? They went to give him a larger pool to access as he was creating this financing machine.
And he's not stealing from his policy by using the dividends and the paid up insurance. That's all still in there. So I had this issue for a long time. I was like, so if I just use my policy for financing things, my policy is going to grow? No,
Right.
no. The policy is designed and there are limitations on it. Okay.
Yep.
If people say, how do I get it to go faster or bigger? Well, you got to start more policies or start bigger policies originally, because you're limited by the design of the policy.
Right.
What this guy figures out is if I don't drain it by using the dividends, and if I don't use the paid up insurance, then it's going to give me more capacity to finance things in the future, and therefore give me more passive income in the future.
So keep in mind, we only used one policy here.
Right.
We only used one policy, but how many trucks did we do? We only did one.
Yeah.
He's got 4 trucks, a tractor and a tree share that he's financing.
Still
So
outside the wall.
All still outside the Great Wall of China through the financing companies.
Right. Right.
So in all reality, he has 157,363. He only pulled 52,600 out because he still has some place to borrow additional money to get more financing taken care of.
He does.
Whoa.
That sounds like another podcast.
It does sound like another podcast. That is awesome. It almost like we planned this or something.
Okay, so far we've shown in the previous podcast, in Exhibit 1, we've got this gentleman starting a policy, and he's throwing $40,000 in for 4 years, and then he just lets it sit.
Yep.
And then he starts sucking out passive income down the road at $92,000.
That's it.
Then it dawns on him that he is financing this equipment outside the wall to other people who are simply charging him interest, and they're getting the money from the same places.
That's it.
The pool. And he goes, well, I've got a pool. Could I finance this truck myself? So he starts experimenting with that, and he starts financing it himself and making that payment to himself instead of to the gatekeepers.
Yep.
Right. So this goes well for him because now he's realizing his payments are actually funding his system rather than having to use his dividends and his paid up insurance. And he's like, oh, now my policy is doing even better. And I'm actually able to now pull out $125,000. I've got more death benefit and more cash value. This is going well. What if I finance 2 trucks? And we will pick that up with our next podcast.
Before we dance out of this thing, I want to throw something out. If you remember back in Exhibit 1 in the financing agreement,
Mm-hmm.
you know, he didn't carry comp or collision, but those would have been premiums that he paid somebody else. Is that correct?
Correct.
To insure his truck.
Mm-hmm.
Well, for him to have $1,000 deductible, he would have paid about $2,100 a year for $1,000 deductible. Do you think he should have taken that $2,100 a year that he was going to pay the insurance company and put it back towards policy loan repayments?
Absolutely.
Well, maybe he should have raised that $2,100 a year to $2,500 a year and had a 0 deductible and really kick this thing in the head. Mm-hmm. I'm telling you, there are so many ways to think about infinite banking that really we're trying to get people to understand. Everybody has a pool. We're going to show you how to access your pool and reverse change the direction of the dollars that are flowing away from you and get them to flow towards you.
Yes. Woo. Okay, so we're going to continue to walk this journey with this logger in our next podcast, and we're going to walk through what it looks like to then take on a couple of pieces of equipment.
2 trucks.
All right. For those of you listening, thank you for joining us on our Life Success Legacy podcast. We have a ball talking about this. Mike Everett, you are in your element, brother. This is a blast. check us out at lifesuccesslegacy.com. If you have not got a copy of Nelson's book, Becoming Your Own Banker, or the Case for IBC, especially if you're a business owner, we recommend the Case for IBC. I will also add, we have a new book in our store on our, hey, look at that.
Look at
Banking
this.
with Purpose, a story about financial freedom through infinite banking. This is a book that there are no numbers and no tables. So unlike what we're doing today in the podcast, where we're really digging into the numbers and the details and all those kinds of things, Family Banking with Purpose is a story. And we realize that people have different learning styles, and not everybody learns by looking at tables and following the decimal points and all that. The book is really to paint a picture and inspire people about what's possible to create a family banking system, but it's in the context of a multi-generational family. And so if you think that is more your learning style, I guarantee you can read it in one setting. In less than an hour and a half, you can read it.
Yeah.
It's less than 90 pages long. So if that's your style of learning, we try to provide a lot of different learning styles. If that you think that's your style, grab one of those and check it out. Okay. All right, Mike Everett, good stuff. Thanks for joining us.
Chris, thanks a bunch.
All right, we'll catch you guys on the next episode.